Hello, everyone. Sorry about that. I think I was on mute, so I apologize. If you can hear me, or if you can't hear me still, I hope you can. But if not, I think I should be back on now. But sorry about that. So welcome to another installment of our Lunch and Learn webinar series. My name is Mayur Thaker. I am your host for today, and today we're talking about the return on invested capital. And so what do the great investors of our generation say about it? And I just was on the slide just a minute ago, but the two things that I think are most important to think about, and this is a quote from Charlie Munger, is that he mentions in his quote, it's obvious that if a company generates high returns on capital and reinvests at high returns, it'll do well. So there's two aspects of this quote that are important to think about. Companies that generate a high return on capital and companies that reinvest that capital at a high return. So we're looking for companies that are able to compound capital. And I'll also mention that if you do have any questions as we go along with this webinar, please feel free to post them in the GoToWebinar panel that you see on the top right-hand side of your screen. There should be a section for questions there. So if you do have any questions, please feel free to post them. And if you think of questions after this call, please do not hesitate to email us at advisortools@zacks.com. That's advisortools@zacks.com. And so what we're going to look for in our presentation today is a little bit of an analysis of what this return on capital means. And what does it mean to be reinvesting at high returns, as per this strategy that Charlie Munger has built his entire investment approach on at Berkshire? So the first question I have is right off the bat is, what's wrong with this chart? This is what we're looking at here is a simple earnings growth chart for Williams Companies. And what is it? What's the problem with this chart? It looks like earnings are going up at a pretty decent rate. We started at about 40 cents per share about 5 years ago, and that's grown to about $1.02 today. So over a 5-year period, that's a pretty good growth rate on earnings. But what's wrong with that chart? What's wrong with it is that it doesn't give us a complete picture of what the return on their capital was. So earnings is one thing, but that's actually a byproduct of the investment opportunities that the company has with the capital that they have. So stated differently, it's ignoring the capital required to generate those earnings. So ROIC is the rate of return on investor capital. So if we think of it in this way, if we look at a simple earnings growth chart, then what does it mean in terms of the way that we think of, interest income? So if we were to deposit $10,000, into a simple savings account, and if it generates 2% per year over 10 years, then this is your interest income that you would be generating. You can see that it's growing at a higher and higher rate, or it's compounding, at that 2% over that 10-year time period. So this is analogous to seeing the earnings of a company. However, your earnings, or in this case, your interest income, is dependent on two factors. It's dependent on the initial capital that you invested into it, and it's also dependent on the rate of return that you're generating on that capital. So ROIC is the return that you're generating. That's the 2% interest rate. So obviously this is a great chart to see. We started off with, no interest income, and that's grown to almost, over $2,000 a year on interest income, by year 10. But what's more important than the raw dollar amount or even the growth rate is the rate of return, as well as how much are we reinvesting back into our savings account. So we're allowing for two things to occur, compound growth and a 2% rate of return on your capital. So ROIC, rather than looking at just pure earnings, which is what, what the previous slide did, what we want to find out is what was the rate of return that the company generated to produce those earnings in the first place. So, Williams and Company, if I look at this a little bit further here, here is a mix of 3 different items. The first one that we see here is the earnings per share, which is what we saw in the previous slide. That's this blue line right here. And it's looking like it's doing a pretty good job of growing over this 5-year period. But if we look at the next number, which is the return on invested capital, you can see that it plateaued roughly in 2017, early 2017, and it's kind of flat to downish. And you can see what that number is. It's about, a negative 1.82%. And what does that mean? The return on invested capital, if you recall, we want to know 2 things. How much are they earning per dollar of capital? And how much compounding is occurring? So for compound to occur, we need to be reinvesting whatever earnings that the company generated back into the business. So what does this mean? Our approach to return on invested capital looks for earnings minus dividends. Because if a company pays out dividends, then that means by default, they're not reinvesting that money back into the business. So you can see here that because Williams has a negative ROIC, that means that they're actually paying out more in dividends than what they generate in earnings per share. So that means, or that implies a negative reinvestment rate. And overall, you can see that it's not doing very well overall with regards to that, as you can see with the evidence of the stock price. We can see that it's, slightly down over this 5-year period. So obviously this is a, company that's, operating within the energy space, and energy stocks right now have a number of macroeconomic conditions that they're dealing with, particularly low, energy prices. But, this tells you a little bit about what types of investment opportunities the company is, currently deploying its capital into. Is the company deploying its capital into high returns on invested capital? Or is it generating very, very low, returns on capital? And this ROIC chart helps you view that very quickly. So stated differently, ROIC helps you determine at what interest rate are they generating on the capital that is provided to them by shareholders as well as by debt holders. So if you take the total amount of capital that the company has, both equity and debt, how much are they generating in terms of the percentage rate of return on all of that capital? So that's what we're more interested in. The earnings per share is a byproduct of how effectively management is deploying its capital into projects in order to earn a return on that capital. So, what is the definition of ROIC? That represents, the net income per dollar of total invested capital. So the formula that we're using here is the net income minus dividends paid, right? So because we're trying to find out how much they're returning or how much they're reinvesting back in the company. And we take that numerator and we divide it by total debt plus total equity. And that gives us our total ROIC. And other approaches exist as well. Another common way to do this is to use NOPAT, which is the net operating profit after tax. You can also use free cash flow in the numerator. And there's a couple of different methodologies, but we're just going to take this simple approach, just looking at, net income minus dividends. And studies show that ROIC is a superior metric than ROE and even ROA, because those other metrics do have their own pitfalls. Like, for example, if you look at the return on equity, and this is another number that's also very important, but ROE, you have to know that it can be distorted with leverage. And the simplest example is, let's say, you buy a house for $500,000 and you put 10% down. And let's say you immediately put it up for rent and you can earn about $25,000 a year from, rent income for that house. So the ROE would tell you that it's a great investment because your $25,000 rent income divided by the $50,000 equity that you put up, right? That's the 10% down on $500,000. that tells you that you're getting a return on equity of 50%, which sounds great. But the ROIC is the real return on the investment, which is $25,000 rent divided by $500,000, price of the house, and that tells you that your return is 5%. So it's a very different number, 5% versus 50%. So, ROE has its own pitfalls. Again, that can be distorted with leverage. ROA can also, understate in some ways the profitability of the company because, the assets may not be fully deployed, immediately. And therefore, it could overstate the denominator and therefore understate the ROIC overall. So, everything has its ups and downs, but ROIC has been shown to be a superior, metric when it comes to determining what rate of return the company is able to generate per dollar of total capital. And here is one of the most important parts of why ROIC is such a good number. High ROIC sustained over a long period of time is associated with the presence of an economic moat. Okay, so what does this mean? And this is a big, big part of the success of Berkshire Hathaway and so many other, contemporaries of Warren Buffett as well. Seth Klarman, talks about this, incessantly. Peter Lynch talks about it a lot. Bill Miller talks about it a lot. These are all legendary investors. And what they've done is, attempt to find companies that have very good ROIC, but also have an economic moat. So what does that mean? If you have a high ROIC over a long time period, then what that means is this company is doing something that's not easily replicable by other companies. So stated differently, if you have a company that does really high ROIC for a year or two, that's going to, ostensibly attract competitors to that environment. So if someone sees that, this company is generating, 20, 30% ROIC, then it's going to attract competitors, and therefore that initial advantage that company had will be competed away with, price wars or, more selection. And therefore the ROIC will then return back down to more, industry average levels. Okay. But if a company has demonstrated high ROIC over a longer time frame, say 5 years or 10 years, then that indicates that company is doing something that other companies simply cannot replicate very easily. So what we want is not only high ROIC, what we want is not only high, reinvestment rate, which is this net income minus dividend, but we also want to make sure that this company has been able to deliver high ROIC sustained over a long time frame. And typically we want at least 5 years, and sometimes even more than that. 10 years would be even better. Because this is all a very, very big picture, long-term investment horizon that, Berkshire and, Warren Buffett's contemporaries have, done, which is buy and hold over a super long time frame, typically 10 years or more. So again, the key to long-term growth is compounding capital at a high rate and for a long time. So going back to our simple, savings account, example, interest income compounds over time only if you keep the original investment in the account and never, withdraw that money. So the investment yields at the best results if, all interest is reinvested, allowing for the compound effect. No funds are withdrawn, and the rate of interest remains higher than what you could earn elsewhere with similar risk. So the key to value creation for businesses is the same. The business retains all of its capital, which means that it has high retained earnings. It doesn't pay out too much of its earnings as dividends. And it also doesn't stockpile cash on its balance sheet either. But what we're looking for is companies that basically reinvest all of their earnings back into the business and then also earn a high ROIC that remains higher than their cost of capital. And we won't talk about the cost of capital in this webinar today. That's a little bit beyond the scope of our call today. But we just basically want to drive home the point that we want companies that earn high returns on capital and reinvest, all of their earnings back into the business to allow for that compounding effect. So let's take a practical look at this. All this sounds great in academics or in theory, but how has this performed over time? And we can see a little bit of what this looks like. I used our, Zacks backtesting software to put this to the test and see how well does this perform. And so these are deciles of ROIC from 2007 to 2020. And you can see here that clearly the best performing deciles are the top two right here, the blue and the orange, are the top decile and the second best decile. And you can see that those two deciles are really running away with the cumulative returns of $1 invested back then. So this looks at purely ROIC with no other overlays or filters, absolutely none. So all it looks at is we're taking, all companies and grouping them into 10 deciles from, in descending order. And we're picking the top deciles or separating each of those deciles and testing how each decile performs over time. And so, as we would expect, the top two deciles, so the top 20 percentile of companies in terms of ROIC, have clearly separated themselves away from the pack. So even without doing any qualitative analysis, any valuation analysis, any other overlays, you can see that ROIC does add additional value as a spread from the long and short side. So let's put this to practice. We want to use the Zacks software to be able to come up with, companies that, meet these criteria. High sustained ROIC for a long time period, high reinvestment rate, no excess cash, and a discount to intrinsic value. So let's take a look at some of these, and let's take a look at a few examples of, companies that have really added value. So, we can see, for example, Williams and Company. I'm just going to come into Advisor Tools here, and I'm going to take a look at the fundamental chart, and that's what we're looking at right here. And let's toss in Williams companies, and so we can just see a quick example of what their return on invested capital looks like. And I'm just going to uncheck, this company right here. And you can see here that their return on invested capital, which again is their net income minus dividend, has actually been negative. So they do pay out more in dividends than they generate in earnings. Now, being an energy company, this may be a little bit deceptive because most of these types of companies generate cash flow rather than net income as the more relevant measure of how much they're producing. But you can see here that, again, it's something that you do want to pay attention to overall. And let's contrast that with a company, Monster Beverage. I'm just going to uncheck this Williams & Company here so that we can see exactly what this is showing us. Over a 10-year time frame, look at the returns on invested capital of Monster. These are just, monster returns, ROIC. You can see that it started off at about 30%. It got up to about 42% at its highs, dropped down to about 12%, but you can see that it's back up to 28%. So this number is going to fluctuate as the denominator does change, as the company does retain more of its earnings, therefore increasing its invested capital. But you can see that the median value over this time frame has been very, very high. And you can see that over a super long time frame, they've been able to sustain a very high return on capital for a long period of time. So this indicates the presence of an economic moat. What is that moat? And in Warren Buffett's, terms, it's Monster's brand. So initially, a lot of folks that were looking at Monster when they invented the category of energy drinks, people thought that this is something that, Coke, the juggernauts of the industry, Coke and Pepsi, would easily be able to replicate and put Monster and Red Bull really out of business, because this is something that's in their wheelhouse, right? Coke and Pepsi are 100-year-old companies almost. And, they've got, tons of experience and tons of capital to be able to do exactly what Monster, has done, which is invent this category of energy drinks. So a lot of, folks and critics in the beginning thought that Monster was overvalued and that this is something that, the industry players could easily, replicate. But you can see here that they really were successful at building a brand. And one thing that, Warren Buffett has talked about a lot is consumer brands are very, very powerful. So once a brand has been created in the minds of consumers, it's very hard for a Me Too to come out and replace it. So that's been one of the reasons why Monster has been such a great allocator of capital, is that, consumers have really attributed this energy drink category to Monster. When you think of energy drinks, you don't think of Coke, you don't think of Pepsi, you think of Monster, and you also think of Red Bull as well. So they've been able to not just sell really well with consumers and become sticky, but they've also been able to continuously reinvest that capital that they generate, that earnings that they generate, back into their own business and earn a very high return on capital over this entire time period of 20 years or more. So that's really what we want to see, companies that can do this. And of course, you're going to see fluctuations like this. Just because you see this number coming down doesn't necessarily mean that, the company is suddenly at risk. Because we could add on top of this, earnings per share over this entire time frame, and just look at how much it's been growing over that time period. You can see consistent, earnings growth. So when this number is coming down, what that means is it's more so the denominator that was increasing rather than earnings coming down. So you can see that as a quick overlay right here. Let's look at another company, another amazing allocator of capital, Dominos. And if you look at the stock price of Dominos, you can quickly see how it's been just a monster success over this entire time frame. And let's go back a little bit to a 10-year time frame, so we can remove a couple of the outliers you can see here. But you can see the same exact thing, right? This green line indicates the return on invested capital. And check out what that number is for Domino's. It's 46%. It's absolutely extraordinary. And you can see over this entire time frame, consistent earnings growth. So again, this earnings growth is the byproduct. That's the interest income, going back to our simple savings account example. That's the interest income, which is the symptom of this right here, which is the return that they're generating per dollar of capital. And so you can really see that, if you know a thing or two about Domino's business model, right? They don't have a ton of retail floor space. They do have a retail presence, but it's a very, very small retail, presence. Most of it is carryout, and a vast majority of their business is online app-driven sales. So, even before the COVID, pandemic, which really just even boosted their, profitability even more, you can see that they were already generating very high returns on capital well before the pandemic, occurred. So this is exactly what you want to see, a very high ROIC, okay, which already implies a very high reinvestment rate, and, delivered over a very long time frame. This is a 10-year time frame here. And we saw this, big drop here, and this is probably due to something other than the numerator, which is net income minus dividends. This could have been something with regards to debt that they raised. I'm not entirely sure, but you can see again that it's been a, phenomenal, allocator of capital. So again, this indicates another presence of an economic moat. Again, it's the brand, right? It's the quality, it's the experience, the consumer experience. Overall, it's a company that has built a reputation, and that reputation is really, really hard to defeat, even with, small, mom and pop shops or other large, chains such as Pizza Hut and others. So again, high return on capital, high reinvestment rate, high ROIC for a long time frame. And again, that indicates the presence of a moat. So these are all exercises that you can kind of conduct on a case-by-case basis within the Advisor Tools platform. And so now I'll just show you, how do we find companies like this? How do we find the monsters and the Dominos? How do we find other potential investment opportunities like this? So let's come over to our screener. And this is the place to go to launch it, would be under screening and screener and backtester. You can use the equity screener as well, but this is a little bit more of a simplistic screener. It won't give you the ability to find long-term averages on ROIC. So you can definitely use our basic screener to find companies that currently have a very high ROIC, but it does not give you the ability to find companies that have high ROIC delivered over a longer time frame. So that does require this add-on, which is the screener and backtester. So I'm just going to launch that here, and this is what it looks like. And here is the criteria that I have in here. And I'm just going to replicate this so that you can quickly see how to do it on your end. So I'm just going to clear everything here and go back to our default database. So this is the first thing that you see when you launch the Advisor Screener. And the first thing I'm going to do is set it so that we search within the S&P 500. So we're just going to come over here, double click on S&P 500 and say equals member. Hit OK. And now what I'm going to do is going to shift over to a database that we call ratios. So if you go to File, Open Database, and go over to Ratios, this is one of my favorite databases that we have because it does exactly what it sounds like. It's a wide collection of various different financial ratios and valuation ratios. So everything from top line to bottom line growth, margins, leverage ratios. Here are the return on capital ratios. You can look at liquidity and valuation. So what we're interested in is the return on invested capital. So I'm just going to double click this here, and I'm just going to set this to be greater than 15%. And there's no magical number to that. It's not a hard and fast rule. You can kind of play with this number to find different ranges of ROIC. But I'm going to start off with 15% here. So we're going to look for greater than 15%. And then the next step is, so this is just a current number. So we're finding companies within the S&P 500 that currently do better than 15% ROIC. But remember, the other aspect of this is we want a high ROIC sustained over a longer time frame. So the minimum amount that I'm going to do is search for a 5-year time frame. So over here under 5-year median, we're going to go back down to the return on invested capital, 5-year median. And I'm going to say this has to be greater than 15% as well. So not only does the company have to have at least 15% ROIC now, but a 15% median ROIC over the past 5 years. Okay. And then lastly, and this is something a little bit outside of the scope of this call, but also a very, very critical component to the successes of, Berkshire Hathaway and Peter Lynch and Seth Klarman and others, is this is the internal rate of return, right? The ROIC is what is the company doing internally with its own capital. However, as investors, right, as folks on the buy side, as advisors, as fiduciaries where we're investing client capital into these companies, it behooves us to also pay attention to valuation, right? Because a company could be a great allocator of capital, but what if they're, extremely overvalued relative to that stream of income that they're generating? So we want to make sure that we're not overpaying for that, for the stock. We don't want to pay too high of a valuation to buy these businesses. So this is something that Charlie Munger has influenced Warren Buffett greatly, is to buy great companies at a fair price. But we really want to avoid a potential pitfall, which is buying a great company at a overvalued price. And that's something that they're currently experiencing with Kraft. And you can see some of Warren Buffett's commentary on Kraft. Kraft is a great business, but in hindsight, they overpaid for that business. So what we want to do is overlay one potential screening filter that may help you, avoid that potential pitfall, and that is utilizing our Zacks valuation model. So I'm going to come over here to the ZQuant database, and over here you'll see the Zacks valuation model. And in a nutshell, what this does is we basically look at the forecast earnings growth of the company, specifically based on analyst forecasts, and we look at the current PE multiple as well as the current macroeconomic risk environment based on the risk-free rate, which is the 10-year Treasury yield, plus an equity risk premium, to give us a fair valuation of the company. So essentially an intrinsic value estimate. So this is a little bit kind of related to the classic dividend discount model, except we're using earnings as opposed to dividends. And we're saying, if a company grows at a certain growth rate, and if we discount those earnings back to present terms using our total discount rate, what is the intrinsic value or the fair value of the company? So as long as that's something above what the company is currently trading at, then that is a potential buying opportunity. So we just want to use this to make sure that we're not overpaying for, companies. So I'm going to use this item right here, model return next year. And I'm just going to set that equal to greater than 0. So it's a very, very simple filter. We're not looking for anything extraordinary. We just want to make sure we're not overpaying for companies as an additional overlay here. So if I hit OK there, now we have a really workable, investment model. S&P 500 member, high ROIC, high sustained ROIC, and companies that are trading in line or at least at a slight discount to its, estimate of intrinsic value. So to run this criteria, let's see who passes right now. I'm just going to hit on run query here. And check that out. Out of the 500 S&P companies, only 38 are passing. So this, presents a very workable collection of super high quality companies. And here's your Monster Beverage that's passing. Here's your Domino's Pizza that's also passing. Yum Brands is another. AutoZone and Best Buy, Home Depot, O'Reilly, Tractor Supply, AmerisourceBergen. Some really high quality companies. Apple, Adobe, Google, Facebook, Paycom. So, Lam Research is another, really good one. Lockheed Martin. So, again, these are all companies that, potentially have, that are, great allocators of capital that reinvest a high amount of their capital back into their business. Because remember, our ROIC is, net income net of dividends as well. So this is the rate of return even after paying out dividends. Okay. And then, a very consistent generator. And these are companies that potentially trade at a discount to intrinsic value. So this could be, an indicator that there is additional upside, to these companies. Now, this is not a black box in any way. I don't recommend just running with this blindly. Of course, we do want to perform additional, due diligence on the companies that, in terms of their, individual business models. So, and a great thing that you can do as an overlay is to say, take one of these companies, and if you want to learn more about them, then a great way to start is to read our Zacks, independent research report on them to get a better understanding of what they do. So if I were to look at ABC here, I can enter that into our main ticker box and, read up on our analyst report on this particular company. So this is a great additional resource to perform additional qualitative analysis on what the company does. Page 2 is a great overview. So if you're not familiar with that company, page 2 is what I typically look at first, and it tells you exactly what they do and what they've been doing in recent, over the recent time frame. So hopefully this has been helpful for you. This presents a very workable solution. This is a super long-term investment strategy. It does not, provide immediate returns, although, going back to our, back test here, it does, show that there is value creation to be experienced. And this is exactly what, the great investors of our time, really have built their investment models on, finding these types of companies that generate high returns on capital. So, one thing that a lot of folks do, for example, if you are a value manager, unfortunately, a lot of value managers have underperformed the market, over the past 10 years. And one of the reasons is because they focus too much on PE multiples or too much on, price to cash flow multiples or things like that, and not enough on ROIC. So if low PE is a part of your investment strategy, then I would highly recommend overlaying that with ROIC, because this is what's really going to separate, cheap for a reason stocks and cheap for no good reason stocks. So this is a great additional, overlay to, looking at PE multiples. And in fact, a lot of folks like, Warren Buffett, don't even look at PE multiples. They look at, ROIC, and they look at, whether they trade at a discount to intrinsic value or not. So sometimes, companies that trade at a discount do have a high PE. Sometimes companies that trade at a discount have a low PE. Sometimes companies that trade at a discount have an average PE. So sometimes PE multiples are not even the best tool, but ROIC is a phenomenal, indicator to separate high quality companies from low quality companies. And so we want to make sure we avoid, pitfalls with that. I'll leave you with one last note is, for example, Ford, if I were to look at Ford here, Ford trades at a very low PE, but you can see that they also generate very low returns on capital at the same time. So if you were a pure value manager and you don't look at ROIC, then it looks like Ford is trading at a deep discount, and it's a great stock to own. But if we look at the ROIC, that tells you exactly why, it trades at such a low multiple, because Ford requires lots and lots of capital to generate those earnings that it does. And here we can see exactly what that looks like. Right now they're actually generating losses again during the COVID, pandemic. But if I were to look at a 10-year time frame of Ford, just check out how low this is. It's declining. It's not only declining, but on average, it generates somewhere between 3 to 4% return on invested capital, which is pretty low. So, again, we want to make sure that if you do use PE, I personally don't excessively focus on PE, but if you do, ROIC is something that you absolutely should be looking at as an overlay to companies that do trade at low multiples. So hopefully this has presented a good framework overall. Hopefully these are a good list of stocks that potentially could generate ideas for you and your clients. If you do have any questions, please do post them in the GoToMeeting webinar, and I can kind of go through some of these here now. A few questions here come up. So the first question is your return on invested capital the same as return on capital? Great question. So no, it's not the same as return on capital. So if I go back here and if I go to browse and go to return on capital, these are the various different returns on capital that we have. And you'll notice there's one return on capital and there's a different one, which is return on invested capital. And the difference is the dividend component. So return on capital just looks at net income. Okay, and return on invested capital looks at net income minus dividends. So it's the ROIC that I like to focus on. ROC is certainly a really good number too. That's definitely, I'm not discounting that at all, because this is the number that, you know, the company will generate on in terms of before dividends are paid out. So this is something that you do want to look at, but return on invested capital, you know, factors in the compounding component. It factors in the reinvestment rate. So it basically says how much money is the company reinvesting back into the business to earn at a similarly high return on invested capital. And so another question that we have is, where would we go on Advisor Tools to see the actual intrinsic value number? This is something that is more related to our flagship investment, research product, which is the Zacks Research System. That's where you kind of can go to do a little bit more in-depth on valuation modeling. So this is something separate from the Advisor Tools platform, but within the Screener tool, this is where you can go to access the values that come from that valuation model. So again, if you go into the Advisor Screener, you want to go into File, Open Database, and open up the zQuant database over here. And within that, you'll see the Zacks Valuation Model category. And within that, this is the number I like to focus on: model return next year, as well as model return current. So this is basically the calculation of intrinsic value relative to the current market price. Okay, so if there's a big difference between present value of future cash flows and the current price, then that's what's going to be captured by this model return current. And then model return next year, so that's a 1-year target return. So as a sort of conservative point of view, I like to use that one and say this number has to be greater than 0. So what that's basically doing is we're trying to find companies that trade at a discount to its 1 year out future expected, intrinsic value. So again, to clarify, this is an input that we use from our valuation model based on our forecast growth, as well as the discount rate, which is that 10-year treasury yield plus the equity risk premium. That's the premium that investors require to take on additional risk within equities. So if there are no other questions, we can wrap up here. And if you do think of any other questions, or if you have any suggestions or feedback, we would love to hear from you. Again, you can reach out to us at advisortools@zacks.com. Again, advisortools@zacks.com. Once again, my name is Mayur Thaker. I'm Senior Relationship Manager here at Zacks, and hopefully you had found this helpful. Again, we'd love to hear from you, advisortools@zacks.com. So thank you again, everyone, and hope to see you again at a future Lunch and Learn webinar that we will continue to have. Thanks, everyone. Stay safe. Have a good day. Bye.